Welcome to Mortgage Talk 101 here on Super Talk 1270. Time to look behind the numbers. Buying, selling, refinancing. Mortgage Talk 101 addresses real issues in real estate. Now, live from the Super Talk 1270 studios, here's Mortgage Talk 101 host, Joe Sheehan.
Well, we're not saying body built for radio anymore. Welcome to Mortgage Talk 101, folks.
Okay.
We are on the air, ready to talk about everything going on in the real estate world today, including the appraisal process. We're going to cover the appraisal process.
Okay.
But after we get through the mortgage rate update and tell you about what's going on in the mortgage rate world, because it's a little bit surprising.
Shocking or just
not shocking,
surprising. Okay.
But with all the good economic news out of last week,
yep,
we certainly would have thought that rates would have gone up.
Mm-hmm.
And right now, today, let's go to the Mortgage Market Guide update. And Mortgage Market Guide, as far as their advice about rates, carefully floating.
Yep.
Carefully floating. Weak manufacturing data out of Europe and China is weighing on stocks, helping rates out. Also helping bonds is the Fed, who will be buying Fannie Mae 3.5s and 4s later this morning. Whoa, wait a minute. They're buying?
Yeah, they're still buying.
Oh.
The Fed's still buying.
That's right, they are.
Yeah,
Okay.
because they're rolling over and they still have to.
They have to buy.
They have to buy. Yeah.
So the news is Fed's still buying.
Yep.
And consumer price index was unchanged. The decline is this year over year-over-year CPI remains steady at 1.7%.
So gas went down, everything else went up.
Exactly. So but there's no inflation essentially according to CPI. So it strips out. So the CPI, since you're not paying more for everything else, and even though you are paying more for the other things,
mm-hmm,
your overall budget on your monthly budget in your house isn't being impacted.
Oh, okay.
While year over year ticked up to 1.8%. So inflation is still cool. The big surprise, and what almost appears as a misprint, was the 40.8 reading on the Philly Fed Index. This reading was well above the 18.3 expected, and the highest reading in 21 years. The index has now been positive for 9 consecutive months. The current employment index rose 10 points in November to 22.4 and hit a 3.5-year high. This is a very good number. It appears that cheesesteaks aren't the only thing sizzling in Philadelphia. So is the economy.
So is that a number that's subject to revision, as they usually are?
Yes, it is.
Do you think that might get revised next month?
I bet it will.
Okay.
We'll see if it's a misprint or not.
Yeah.
Existing home sales only rose by 1.5% to an annual rate of 5.26 million units. Above what was expected, the 5.26 is the highest for the year, as low mortgage rates and an improving job market drove buyer decisions. So we are finally starting to see some impact in the home market from an improving job picture.
Okay, so the existing home sales only went up 1.5%. That's a low number.
It is a low number.
Okay, so does that have, what's causing that? Is that no borrowers, but in the same instance, no inventory? I mean, that's certainly a problem here in North Dakota, is inventory. So then, if you can't afford the new construction, there's no homes being sold. And in other parts of the country, a lot of investors have bought up existing inventory and are renting them.
Right. Yeah. The jobs picture is not great everywhere.
Yeah.
The jobs picture is great in some places. Every place the jobs picture is great, you have no inventory. Where you have inventory, you have no jobs.
Yeah.
And so
it's amazing how that works.
So the numbers are likely, you're right, the numbers are likely to be small and low in terms of recovery until the jobs picture improves everywhere.
Yeah. And maybe some people decide, hey, I'm going to move up to a home that opens up the existing home, et cetera. Yeah.
Right. Yeah. And I don't know that we have a lot of that.
Yeah.
The 30-year fixed rate mortgage, from the Freddie Mac survey, 3.99 down from last week with half a point. Last week it was 4.01. A year ago at this time, the 30-year fixed rate mortgage average 4.22%.
Oh, so like almost a quarter point.
Last year at this time, weren't they saying rates were going to be up?
5.
Yeah.
By the end of the year, possibly. Yeah.
15-year.
Our friend Bill Bodner continues to be on the
Correct.
nose.
The Oracle 15-year fixed rate mortgage this week at 3.17% with a 0.5 discount point, down from 3.2 a year ago. 3.27.
Yeah. You know what? I feel good today.
Yeah, about the
Because,
rates.
we think.
About the rates.
Well, yeah, that. But, we had somebody call me at my office yesterday. It was one of our borrowers. And this is somebody that had not refinanced yet. Had their loan for a few years, actually, but had not refinanced yet. They were getting stuff in the mail from some company about refinancing. They called me to check on it. And I said, you know what? If you can go out and do a 15-year mortgage and you can afford the payments and stuff, which I bet you they could, you should go refinance because 3.17, right, on a 15-year, great deal.
Absolutely.
And I suspect, and they were not from Bismarck Mandan here, but I would suspect their home has gone up in value, so they're going to be able to get rid of mortgage insurance.
Get rid of mortgage insurance?
Yep. So they actually were, had an FHA loan, and their premium was dated before, so it was the old premium basis, so they had their mortgage insurance wasn't that bad. So anyway, I felt good about that. I mean, I was like, hey, you help someone. They were smart. They called us and asked us, about, I keep getting this in the mail, this solicitation. You know what? Go to your local lender and check this out and see if it works for you or not. So I felt good about that.
Absolutely. These low rates are giving it's kind of like so many chances for everybody to take advantage of it and do something like what you're talking with. It's just financial restructuring.
As much as I don't want to lose a customer,
right?
But for that person, that was beneficial.
Oh, can you imagine the amount of equity they'll be able to build? Maybe their payment won't go up a lot. Oh, no, it's a fantastic idea. If you haven't done that yet, that's the bottom line of the rate report. The bottom line of the rate report is giving you an idea that if there's an opportunity out there, get in front of somebody who knows. Yeah,
and it's not so much the refinance into another 30. It really look at can you afford something at a shorter term, that 15 years.
Get rid of PMI.
Yeah,
even if you were going to stick with a 30,
big one. Yep.
Getting rid of PMI. Something like that.
Well, when we come back, Joe,
we got the headlines.
We got stuff.
We got headlines from Dave. We've got the appraisal issues from me.
Okay.
After the break here on Mortgage Talk 101.
Right now, it's 18.
Get the app called Radio Pup for your iPhone and take us everywhere you go. Bismarck and Mandan's own Super Talk 1270.
Who?
No, the Who.
The Who.
The Who.
Oh.
The Who. Whom? The Whom. Was there ever a band called The Whom?
The Whom.
Somebody try. I wonder if anybody ever tried that.
There's some tribute band out there called The Whom. Yeah. Or The Who's.
Some dumb kids gonna go play in the bars. They think, it's called stuff The
Whom.
Whom.
You know, at some point there was a tribute band called The Who's, WHOSE.
Yeah.
And then there was a rival tribute band called The Who's, WHO'S.
Yeah, there you go. Yeah.
I mean, just
there probably was.
And so, who are you going to see? Are you going to see the Who's or the Who's? Well, the Who's do a much better job about the Who. Oh,
WHOZE.
Oh, there you go.
Now that's
WOOZ, WHOZE.
Yeah. You could get tricky with that word. Yeah.
Oh, that's great.
And then there was yet another band that spelled it WHO3SE, and the 3 was silent.
Oh.
I think that was something Keith came up with when he was...
the Silent 3, that sounds like some sort of mind-altering substance involved.
Yeah,
I was
exactly.
going to say pharmaceutically enhanced creativity.
There you go.
Yeah.
Okay.
Which in the mortgage world, that phase is long gone. That was the 80s.
That was the 80s in the mortgage. It was the chemically enhanced,
creatively enhanced, or enhanced, pharmaceutically enhanced creativity. That was okay. That was the 80s.
Well, let's leave that topic.
Yeah.
Okay. Hey, a little by the numbers. Should we do that right now?
Yes.
A little by the numbers. Okay. We got here's what we got. Individual income taxes. This is from our friend Michael Higley. He runs by the numbers every Monday. Individual income taxes paid to the IRS would have to increase by 35% for American taxpayers in order to eliminate our $483 billion deficit for fiscal year 2014. I wouldn't go over very big.
35%.
35% increase.
You got to. Who don't you want to contribute? It's time to pay.
Let's just pay in extra. Everybody, just pay in extra what you can. You think anybody go for that?
No. The one thing, if you could figure out how to make everything in the world work like the give a penny, take a penny.
Yeah.
You go to every convenience store.
Yeah.
And every convenience store has a little tray or a little cup, and it's give a penny, take a penny.
Yeah.
And if we could figure out how to create procedures, we would only need one policy in this world regarding everything.
And
it would be, how do you run the world? Give a penny, take a penny.
There you go. Yeah.
And if you could just figure out how to write the procedures from that one rule for everything in the world,
it's all a wash.
It's the only policy you need.
Yeah.
To give a penny, take a penny.
We should think about that. I think we should send a little email to our senators and representatives, see what they think.
Yes.
Maybe they can instill a policy.
Go ahead and take your entire legislation and reframe it under give a penny, take a penny.
Yeah. Just blow everything else up that we have. Just
not the Constitution, but
no, you keep that, but you blow up all this other stuff.
The Constitution really is a give a penny, take a penny document.
Yeah, you could look at it that way.
Because it's free will.
Free will. Yeah.
You
have inalienable rights, and
you don't have any guarantees.
Yeah.
You
checks
just have
checks and balances.
Compromise.
Yeah.
You don't have any guarantees. You just have a right to, and here's the rights that you're protected. Here's the protections you have.
Yeah.
To be able to walk through life, and if you'd like to, give a penny.
I think you might be onto something.
You could take a penny.
I think you might be onto something.
And nobody's gonna make you give a penny.
No.
It's a suggestion.
Yeah.
But if you give a penny, guess what? There'll probably be a penny to take when you
can take one.
Well, it's kind of like Frank Zappa's philosophy of life. Do what you want, do what you will, just don't mess up your neighbor's thrill.
Hey.
And when you pay the bill, kindly leave a little tip. Help the next poor sucker on his one-way trip.
Okay, so
Mr. Zappa. So that
would be the preamble.
Yeah, there you go.
Works for me.
To the give a penny, take a penny.
Frank Zappa.
Do whatever
that and don't
you
eat
will.
the yellow snow.
Just don't.
Instead of Dodd-Frank, we get the Zappa bill.
Yeah, exactly.
We get the Frank Zappa.
Timber
that would be
Gore
cool.
would not be too happy.
All right, back to
Okay, crazy numbers. Okay, a child born in this 2014 begins kindergarten in the fall of 2019 would attend college between the years 2032 and 2036. If that child attended an average 4-year private college, and if the annual price increases continue as they have over the last 30 years, which is 5.5% per year, the aggregate 4-year cost of the child's education would total $485,000 or $121,000 per year. Somewhat less crazy numbers if the same child would go to a public in-state 4-year college, 5.6% increase per year, so actually increasing a little bit more than the private. 4-year cost, $220,000. That includes tuition, fees, room and board, $55,000 per year. So, folks, if you have a child born this year, it's going to be expensive 18 years from now. Don't they say it costs
give a penny, take
child?
a penny won't fix that.
That might not. No. Don't they say like a child will cost a parent is it like $500,000 or $250,000 on average
to raise a child?
Yeah. It's a huge number.
It's like
a huge number.
I think it's like $500,000.
Yeah. Okay. No, we spend a lot of money on stuff, right? U.S. government is projecting that it will spend $944 per month on each Medicare beneficiary during 2014. That's per month. $1,000 per month on each Medicare beneficiary.
And
there are currently 52 million Medicare beneficiaries. That's a lot of money. Yep. Okay. Okay, well, this is fun. Confusing. During Alan Greenspan's 18 and a half years as Fed chairman, the Federal Open Market Committee statements averaged 210 words with a reading level of 14, meaning reading level of a college sophomore. So a good chunk of the people could understand what was going on in fairly short, 200 words. Yellen for Jellen, Janet Yellen. Her first 5 Open Market Committee statements averaged 800 words with a reading level of 19, meaning a reading level 3 years beyond that of a college graduate. So apparently I have not been able to understand a word of those statements if I read them. So we're in trouble, Joe.
And the question is it because what she's addressing
is
that complicated?
compared to what Greenspan had.
Right.
Yeah.
Or
I don't know.
or is she making
Making it
very
more complicated.
statements? No.
A little of both, probably. Yeah. Anyway, that's a lot.
I do think though. I wonder what Bernanke's were.
Yeah, it didn't
Doesn't
put him
address
in
that.
there. No, that would be good to know.
It would be good to know because
Yeah.
my guess is that truthfully, given like what we're talking about, with the globalization of the economy since Greenspan's days, the Fed statement probably is a lot more complicated.
Yeah, I would say it is.
I mean, we got Japan hitting their fourth recession in
in 6 years.
6 years,
Yeah.
and we have the problems in Europe, and each one of those so much more dynamically impacts us than it used to.
Mm-hmm.
That maybe that's just that
Maybe
complicated.
Yeah. So, but apparently, I'm not going to be able to understand them.
That's why we need to get a smart guy in here again.
Yeah. Okay. Let's see one more. Oh, this is not a good number. Okay, we just had the midterm elections. Right. An estimated 37% of eligible voters cast a ballot in the midterm elections. That's the lowest percentage nationwide in 72 years. Wow. The last time that few voted was 34% in 1942. What was going on in 1942? A little thing called World War II.
We had a lot less voters available.
Yeah, a few. And the voters that were here were really busy building stuff.
Right.
Yeah.
Yeah.
So
holding down the hatches.
was anybody going to change the ship at that point?
Boy,
in time?
no.
No, you would just we're staying the course.
We better.
We're not switching. We're not kicking anybody out.
No.
Yeah. Okay, and here's just bad luck. This is a sports-related question. We're, of course, in the middle of the NFL season. NFL quarterback Carson Palmer from the Arizona Cardinals tore his left knee ACL last week, just 2 days after he signed a 3-year, $47.5 million contract extension. Okay, in 2006, Palmer tore the same ACL on his left knee just 10 days after he signed a 6-year, $118.8 million extension with the Cincinnati Bengals. Moral of that story is, don't sign Carson Palmer to an extension because it's going to cost you.
He should refuse it.
Wow, he should refuse this extension. Just pay me a year at a time.
Year at a time.
He didn't learn. Okay, let's see. What else do we got? Ooh, did you hear about the big fight between Elizabeth Warren and our friend Mel Watt, who's running the Federal Housing Finance Agency?
It figures because Mel Watt is actually, since he's come in, Mel Watt has actually been making some really good decisions.
But you know what?
So it doesn't surprise me that there's going to be some fireworks between the two of them.
Elizabeth Warren, who is a senator from Massachusetts, and she was kind of the...
She created the CFPB.
She created the Consumer Financial Protection Bureau. She's also being touted as a possible presidential candidate for 2016 on the Democrat side.
Because there are people out here that think that it can get worse.
Yep. And you know what her response... Mel Watt was testifying in front of the Senate committee, and her attack on him is that he did not... since he took over the FHFA, he has not helped one single person at all. Said, you have done nothing. And she was basically focused on, you haven't agreed to do principal reductions. That was her big beef. But that was the word she used, was you have not helped one single person.
Okay, so you're not sure what to say about that because the whole thing is, his whole job is to save and sustain and
Fannie and Freddie. He's got to.
How does he do that without money?
Yeah.
Who's going to pay for principal reductions?
Yeah. He's got to weigh everything.
Unbelievable.
Yeah.
Back. We'll address that when we come back after the break. On Mortgage Talk 101.
Right now, it's 18.
Get the app called Radio Pup for your iPhone and take us everywhere you go. Bismarck and Mandan's own Super Talk 1270.
And we are back on Mortgage Talk 101. Joe Sheehan.
Dave Flohr. You know what?
All right, so we're coming back from the break talking about how Elizabeth Warren looks at the head of FHFA and says, you haven't helped a single person because you didn't do principal reduction.
Yep.
And we're talking about this, Dave. Everyone has complained. Why do we need GSE reform? Why do we need GSE reform according to everybody out there?
Because they don't have any money. It's the taxpayers are on the hook. And
they had to get bailed out by the taxpayers.
If we have another problem, taxpayers are on the hook again. And
so Mel Watt's whole job, his number one job, is to solidify Fannie and Freddie, to make them viable entities, to correct the course of the ships. If you do principal reductions on the loans, is this helping or hurting the financial viability of Freddie and Fannie?
Yeah,
it's hurting.
Yeah, absolutely.
You are directly in real time impacting their capital.
Mm-hmm.
How can you even suggest doing that when you're still talking about GSE reform?
Yeah.
If GSE reform was off the table and you said Fannie and Freddie are overcapitalized in a good position with reserves to give something back and still remain viable, then it would make sense. But if you're talking about doing principal reductions on entities that you say are still currently not viable and need reform, you're talking about a taxpayer bailout of other borrowers, period.
Well, right now.
Or of the entities, because you're going to weaken the entities and it's going to take a taxpayer buyout to secure the entities.
No, she is saying that, there were, and I remember reading this, there were studies, a couple of people did a study that said, hey, principal reductions could actually benefit Fannie and Freddie, because it then maybe would keep more people, they'd stay in their homes, they'd keep making their mortgage payments. So, but you've written off, obviously you've written off, say you write off $50,000 to get them down to where they can afford to place. And hopefully those people will stay in the home and keep making their mortgage payments, and then you'd be okay. That's the argument.
So I'm buying it when you had foreclosures escalating.
Yeah.
When you had foreclosures escalating and they were going through the roof, would that have been a good time to maybe consider doing that?
Maybe.
Okay.
Yep.
Because you're going to take the losses either way.
Either way.
Now what you're trying to do is you're employing a strategy to reduce inevitable destructive losses.
Yep.
Is the foreclosure rate inclining or declining
It is
now?
declining.
Why? That is so late to the party.
That's her argument, but you're right. That's the word to use. It's late to the party. I mean, if that was going to be done, it would have been done. And Mel wasn't in charge in
that time.
It would have been done 5 years ago.
Mel would have done it back then.
Probably
I do
would
believe
have.
he would have, because to say that he hasn't helped anybody, the first thing he did was help all of us by not doing anything.
Yeah.
When he first came in, just so you know, when Mel Watt first came into the FHFA, the first thing that was happening, it was already on autopilot, was that the G fee was going to raise.
That's the guarantee fee, which
charges us more money.
Lender pays to Fannie and Freddie.
Yep.
It's the lender paying it, but it comes back. It's costing the taxpayer, the home buyer, something.
We charge higher interest rates to cover that cost.
Right.
And so fundamentally, folks, he has lowered everybody's interest rates by not allowing the G fee to go up. Mm-hmm. He reversed a policy that would have automatically made your interest rates higher for anybody buying a home after that time.
Yep.
So to say he hasn't helped anybody, he's helped everybody who has bought or refinanced a home with a mortgage since he took over. What was it?
About a year ago.
Yeah, about a year ago. So
it was January.
Everybody who's locked in an interest rate over the last year is automatically helped by Mel Watt saving money. And as I would say, based on that increase, that G fee increase, by as much as maybe 0.25%.
Yeah, whatever it is, you can't. It's harsh to accuse him of not under his reign that nobody has been helped.
Oh, by the way, how else has he helped them? In 1 year, we've seen a dramatic turnaround in the viability of Freddie and Fannie.
Yeah, so
much so that GSE reform talk has been stalled. Because nobody believes it's an emergency anymore,
right? Exactly.
And if you can't say that having access to a 30-year fixed rate mortgage hasn't helped anybody in the last year, I don't know what planet did.
She was doing a lot of posturing.
Was she born on this planet?
She's doing a lot of posturing, a lot of politics involved there. I think she's trying, she's being mentioned as a presidential candidate, so I think she's trying to get a certain segment of the population behind her by taking, going down these roads. But yeah, it's. I thought.
So what
it
else
was
does that
very
article
harsh.
say about it?
It just think it's very. Watt was it said was pretty much surprised by this attack, because I mean they're of the same political party. They were senators together for a short period of time before he took this job. He was surprised by it, and he said, "Hey, I think that's said kind of the same thing. I don't think that's a correct thing to say, that we haven't helped anybody." But I think he was surprised by it, so he didn't really have an answers off the top of his head for it. He was totally taken aback by it.
What's so funny about this is that Watt, Galante, Stevens, all these people that got appointed into these positions to try to handle the bleeding on the housing agencies that were in trouble, really, really outfoxed Congress. And actually, in the way how they outfoxed them, folks, they succeeded.
Yeah.
One of the headlines is how FHA has almost 4 times as much capital as what they were expecting to have.
Yeah.
It's like 1.7 billion or something. Now they have 4.4 billion.
And the other thing to remember about FHA.
Wait a minute, FHA. Remember FHA that just 6 months ago was in trouble?
Yeah. But the other thing to remember about them, that's the mortgage insurance fund. The actual cash reserves, I believe, of FHA is over $40 billion.
$40 billion.
So if they took some of that and moved it into the mortgage insurance fund, they could probably get to the specified capital ratio.
And it has them. Well, and it has them. So on their reserves fund, they're capitalized by, was it 42%?
Yeah.
42%.
Yeah. So
that's not a number you use with an institution that's on the brink.
Right. Yeah. So
and so then the argument is, so what they did by charging homeowners more money, admittedly, is they essentially, you cannot argue that this program is on the brink, or that it's in trouble, or that it's doing poorly, or that it's. So what do? What's the FHA Reform Act you want to come up with for that? Well, you can't, because they fixed it. And you and I talked about this when they were, a lot of the industry was just irate when FHA increased the upfront premiums and the annual
life of the loan
and the annual premium, and went to life of loan. And you and I both said they have to. If they don't do it, they're going to wind up. Congress is going to try to fix them.
Yeah.
But if they fix it before Congress can get to them, and they did it in 1 year, basically what, 2 years?
Oh yeah,
Year and a half.
Year and a half probably. Yeah.
A year and a half. Now they're sitting there with money.
Yeah.
And now you can argue if there's enough in the enough in the insurance,
right?
But you can't argue if they have enough money.
Yeah, even though I think some lawmakers did still criticize them, say, well, they're still way below what the required ratio is in the insurance fund. But I think you have to look at it as, but they're heading in the right direction. So at least,
in a year and a half.
At least the people at FHA, you're right. They've said, let's fix this ourselves rather than having Congress try and fix it, because we'd be sitting there. Well, they'd still be sitting there waiting for Congress to fix it, right? Yeah. No, good news though on this whole front of Fannie and Freddie and everything. Tim Johnson, our esteemed senator from our neighbor South Dakota, he had proposed a finance reform bill, and he said because nothing has happened this week. He said because nothing is happening, he is urging Mel Watt from the FHA to engage with the Treasury Department in talks to end the conservatorship of the mortgage giants if Congress doesn't proceed with housing finance reform.
Take him out of conservatorship.
And Tim Johnson is now retiring from the Senate, of course, so we won't have that voice. But it's not. Hey, I mean, it's nice to have I think a senator stand up and say, you know what, if Congress isn't going to do anything, then you know what, Mel, go fix it, like you're trying to do right now. Just keep moving and fix it yourself.
Yep.
That's a good. I think that's probably the best plan they got.
It's the right answer.
Yeah.
The only issue with taking out a conservatorship is that it removes them from the exceptions of the qualified mortgage.
Yeah. Right. Yeah.
And we'd have to figure out what that means and how that.
Yeah. But
they might have to rewrite that to say that Fannie and Freddie are still an exception to that, even though they're not in conservatorship.
Yeah.
But,
We can get there.
Okay, well, after the break, if we got time, we're going to get to. I got a couple of appraisal questions.
We'll talk about that. We got questions that we want to answer.
You bet. Absolutely. After the break, we're on Mortgage Talk 101.
Right now, it's 19.
Get the traffic and weather information you need anytime on Super Talk 1270 and online at supertalk1270.com.
People try to put us to down, talking about my generation, just because we get around, talking about my generation, things they do look awful, talking about my generation.
Yeah, we're back. Mortgage Talk 101. Joe Sheehan?
Dave Flohr.
All right. So, whose generation are we talking about?
Well,
there's a few.
There's a few. I got one for you here.
Okay.
It's bad news. Then we'll get to the questions on appraisals. Yeah. Okay. This comes from Zero Hedge, Tyler Durden. Something is dreadfully wrong with this picture. This came from the report released by the National Center on Family Homelessness. The number of homeless children in the land of the free now stands at 2.5 million. So that is the highest all-time high. And that is roughly 1 out of every 30 children in America. And they correlate this with that the Dow Jones Industrial Average, the stock market, is also reached an all-time high. So same time we have a record number of homeless children in this country, the stock market is at an all-time high. And then they go on to talk in an article about that it's related to the wealth gap and all that. The percentage of where all the wealth is concentrated, and the people, if you're born wealthy, you're probably going to stay wealthy in today's world. Mm-hmm. But if you're born poor, you got a 70% chance of staying poor in today's world. And consequently, homelessness can become a problem. So something to think about, folks.
Yeah. I mean, correlations don't equal causation.
No, it doesn't. No.
The only part of that you would question is that the wealth, when we gain in the wealth track, we also gain in tax revenues.
Yeah.
And that's where we pull our safety net from, is the tax revenues. Yeah. And so is that, even though the percentage of people who have more is less, they pay more than they paid before.
Yeah. It's I would wonder. I would be more interested in that if you could give me some sort of connection between the probability of that correlation impacting a shrinking middle class. Yeah, well, and they talked about that in the article too, about, there's the middle class is going down because we're not creating middle class jobs. And that doesn't allow the person that's born poor to increase and become middle class or wealthy.
I wonder I wonder who figures that out. I wonder who figures out for you to afford this, and this. 3-bedroom house with 2 cars, 2 vacations, or whatever it was.
Yeah,
I remember we were going down that list one day. There was an article who figures out. So we know what that costs.
Yeah.
But who figures out what jobs could afford to pay that?
Yeah.
What industries? What industries could create what jobs to actually create enough people in that category to have an adequate middle class?
Yeah.
I wonder if anybody's written the paper. Next time we talk to Elliot.
Yeah, Elliot Eisenberg would probably know. Yeah.
Elliot disagreed with us, by the way.
Oh, did he?
Well, because I don't know if he disagreed with you. I'm assuming he'd disagree with us on this, because with FHA doing so well.
Oh, to his blog today.
With FHA doing so well, one of the things I think you and I would argue for is, if you want to get housing back on track, increase liquidity through programs we're using, which would be lower the annual premium on FHA, because that directly helps more borrowers qualify for more houses. And he comes out and says, no, that will hurt FHA.
Don't change a thing.
Don't change a thing.
Yeah, I would argue that you should drop the life of loan, because you can look at when loans prepay I mean, meaning people refinance or move. There's a average.
There's a point where life loan isn't going to help you.
The life, they're not in
On
that house
average.
anymore.
Right.
So don't worry about it because you're not going to get those premiums anyway. So cut off the life alone thing, and I say increase the upfront premium, reduce the annual premium, and I think you could figure out the numbers that you could at FHA, and you could get to the same point that you're at now with those changes, and really help people with
And
that
maybe
lower annual
even
premium.
improve your reserves.
Yeah.
Because by putting more people back in the market, you're doing more units.
Yeah,
And
exactly. Yeah. So anyway, let's get to the appraisal questions you had.
So the question I've got is, Joe, I'm
That's
buying
you.
a home.
That's you.
Yep, Joe, I'm buying a home, and I disagree with the appraiser's value. My lender seems unwilling to do anything about it. What are my rights as a borrower regarding my appraisal?
Oh. Okay.
Yeah, I don't know that you have any rights.
I don't think you have a right because number one, an appraisal is done on behalf of the lender.
Yes.
Because they want to know that what they're going to loan you, there's enough collateral there.
It serves as a function to protect you as the borrower.
Right. It does
now,
that.
Here's the understanding the appraisal process is probably the beginning of the whole problem. And what you have to understand is that in most situations, when an appraisal is ordered, it's nobody picks the appraiser. And this is all a part of the Frank Dodd Act.
Right.
That it's called AIR, Appraisal Independence Requirements. In other words, the lender, a lot of times your loan officer, well, in fact, every time in these circumstances, your loan officer isn't even allowed to know who the appraiser is until the appraisal is complete.
Right.
In most cases, your loan officer isn't even allowed to talk to the appraiser ever about anything regarding your appraisal. So there have been firewalls put up between loan officers and appraisers where the ability for the loan officer to do anything for you regarding that appraisal is probably extremely limited. Now, so how does it get done? Well, what happens is when your file goes into the system, somebody from the bank or somebody from a third party, somebody who doesn't even work for the bank, sends the order to an appraiser. How is the appraiser picked? Randomly off a list. Randomly off a list. Now, the list might be approved by the institution, but still it's done randomly. If it's done by a third party, the institution doesn't even approve who's on that list.
Right.
So the appraiser appraises the house, turns it back in, and you disagree with the value. Let's say in this case, I'm guessing the value was too low. What can the bank do at that point? Really nothing, because the one thing that one of the requirements of the appraisal independence requirement in Frank Dodd is that the lender can never, under any circumstances, influence the value of the property as the appraiser sees it.
Yes. The only thing they could do is if they, and I'm guessing here because I don't do this on a daily basis, if the underwriter saw something that was an error that they thought, and they could question, is that the right, we've got it that this is a 3-car garage and you've got a 2-car garage.
You said this comparable
down.
is a 2-bedroom. Actually, we got documents that say it's actually a 3-bedroom.
Yeah.
Could you please correct the appraisal?
Yeah.
Now, you're exactly right. So if the underwriter recognized errors, the underwriter can then ask the appraiser to correct the errors and reflect the impact on value.
Right.
If the appraiser believes there is an impact on value.
Right. They could say that doesn't make any difference.
But the underwriter can't come back to the appraiser and say, I think that you shorted this appraisal by $5,000. Please make these corrections and adjust the value. The underwriter can't say that.
Yeah.
The underwriter can only say, please correct this and let me know if there's any impact to value.
Yeah. Okay.
That's it.
Yep.
And so then the appraiser makes the corrections and reflects it or doesn't reflect it. But there's never a time. Now, what can happen is on underwriting, you can say that an appraiser did not comply with the guidelines required to determine the value for your underwriting guidelines.
Okay.
So if somebody turns in a $300,000 appraisal and the underwriter looks at it and says, you know what? These comps are too far away. They're all outside of what we require to determine that a property's
So you might be
correctly.
looking at, in this area of town, you want everything to be within a mile.
We might have guidelines, and Fannie does, and Freddie does, and FHA does, that says here's what here's how a good appraisal reflects the market. And if you're outside of those guidelines, the underwriter would say, "Sorry, I can't accept this value given to me by the appraiser because it doesn't sit in these guidelines." It doesn't mean they're questioning the value. What they're saying is the value as proposed doesn't have the underwriting requirements for them to approve the loan.
Right.
But they're not going to call the appraiser back and tell them to change the value.
Yeah.
They're just going to
That
say,
is-
I can't accept the appraisal. The appraisal's not sufficient.
Yeah.
If you can give me a different appraisal that sufficiently affects the guidelines, I can accept it. The value is a moot point.
Yeah.
Except for then when you're determining
If the-
the other parts of the guidelines,
Yeah.
like loan to value, down payment requirement, and all that stuff.
So the
So what are your
bottom
what can you do?
bottom line, the
Not
only
a lot.
person that can adjust anything on that is the appraiser themselves, if they feel there is a change that
Right.
they made a mistake. I made a mistake on that comp or whatever. And
So,
that's really
so
the
what
only
can you
thing.
do as a borrower? If you have information, comps, whatever, if you have other comparables, you can submit those to the lender. The lender can, depending on what their policy is in their institution, like what we would do, is we would submit those to the appraiser through our appraisal ordering desk, say the borrower provided this information, not us. The borrower provided this information. They would like a response as to how these would impact the value or why they weren't considered.
Okay. Yep.
So any information you'd have can be submitted to the appraiser. The appraiser can be asked to respond to it. Some appraisers won't respond to it, and you can't make them. And some banks will do this, and some won't. Now, what we will do, too, is we'll also do other enhanced reviews and stuff outside the process just to make sure
All right.
to
Good.
double check it.
Good info.
But really, depending on your institution, not a lot you can do. And if the appraiser refuses, nothing you can do.
All right. Yeah.
So, all right.
All right.
We'll
Next
talk.
week's
Turkey
Thanksgiving.
Day next week.
We're not here.
Happy Thanksgiving,
All right.
folks.
Bye.
And the music's alright. Mama's got a squeeze.
ABC News, Super Talk 1270. Accurate news, stimulating talk. This is KLXX AM, Mandan, Bismarck.